I'm currently earning 68% on my DeFi passive income portfolio, where I utilize different crypto assets to earn a passive income. I'm going to be rebalancing my portfolio pretty soon, but I wanted to go ahead and showcase to you guys what I'm currently in and what my plans are for the future. So my first position is going to be Archimedes Finance. This is the strategy of Ethereum to Ethereum Plus. Now I deployed roughly 1654 into this strategy, and it's currently worth 2272. So obviously I've seen some good price appreciation. That's mainly because this has full exposure to Ethereum, and of course Ethereum has gone up a ton in the past 90 or so days, and I've been in this position for 115 days. Now I have only made $65 in overall earnings. That brings me out to an overall profit of $680, which is 40% return on investment, but keep in mind only a fraction of that is from the actual fees generated. Now additionally, this is doing roughly a 13% APR. Now this is through Archimedes Finance, and I do want to go and mention that they did fund my deposit into this position. I have loved the results so far, but personally I am going to be withdrawing from this pool, mainly because I think that capital could be better allocated elsewhere. Now the other thing is, I would throw my normal just Ethereum stash that I'm currently staking for 4% in this position, but again, then I'm taking on smart contract risk, not just with Archimedes Finance, but also with Convex Finance and Curve Finance. And as we've seen in the past, Curve Finance has been hacked or exploited before. So that's something that I'm going to be getting out of and just allocating to a concentrated liquidity pool. Now, while we're on the topic of concentrated liquidity pools, I also have a wrapped Bitcoin thematic position. I have currently deployed roughly $15,000 into this position. It's currently worth 14.5K. So obviously I lost about $500 from price depreciation right there. However, my permanent loss is next to nothing. It currently sits at $1.66, but I've made over $1,220 in earnings, which is ultimately the gold in this space, right? I have practically no impermanent loss. I have exposure to two assets that I were already holding in my crypto wallet, and I'm earning roughly 56% APR, and that's for the past 53 days. So that brings me out to an overall profit of $719 after you factor in the price depreciation. Now, even then, that's a win in my opinion, but even if this price was say negative 4,000 and I had $1,200 in earnings, that would still be a win to me, because once again, these are assets that I planned on holding either way, but by having them in the liquidity pool, I almost have some form of hedge because I'm making those earnings. And by the way, in the next few days, I'm going to be posting a video about how much money I have made in January. In December alone, I made roughly $10,000 from cryptocurrency and DeFi, so I'm pretty eager to share with you guys how much money I made in January. So don't forget to drop a like and subscribe when notifications turned on so you do not miss out on that video. Now the next thing I want to share is this yielder position. This is Ethereum to USDC. Once again, another disclaimer, they did fund my deposit into this position, but so far with the results that I've seen in the audit that they just released, I am probably going to be deploying the capital from Archimedes Finance into yielder just because the yield is so much better, and I am comfortable with taking on the risk for a 100% return on Ethereum to USDC. So how this essentially works is I'm using roughly 2.25x leverage. You could go all the way up to 5x leverage if you're super risky, but personally, I'm more on the lower risk side of things, and I like my portfolio being passive, which is why I chose 2.25x leverage. I do not have to monitor it too often, and the liquidation risk isn't really that much whatsoever, considering it's only 2.25x leverage. But basically how that works is, since I deployed roughly $1,500, I essentially deployed a total of roughly $3,300. However, that $3,300, I can't just withdraw that and put it into my wallet and steal it. Obviously, it's all done within the yielder smart contract. So I have that 3,300 worth of exposure, but my initial assets are 1,500. Now the risk obviously is I'm taking on 2.25x the asset market risk basically. So if the price moves up 10%, I make 22.5%. If it moves down 10%, well, I lose 22.5%. So that's something to be aware of, but the additional aspect of it is I'm also getting 2.25x the earnings. So ultimately, if I divide this 99% by 2.25, this position would be doing 44%. However, since I'm leveraging it, it's doing next to 100% per year. Now, this has an overall profit of $25 in the time span of a month. Not too crazy. However, when you factor in that I have roughly $100 of price depreciation and I have roughly $132 of earnings, that's not too bad. Now, the thing I will say is I do have $60 of impermanent loss. So in this scenario, impermanent loss is relatively high compared to the overall earnings, so that is a risk that you need to be aware of. Impermanent loss is naturally going to be higher. But once again, it's always going to be like that in an Ethereum to USDC pool. If I were you, I would consider checking out some of the other pools with correlated assets on this platform. They have pools like ETH to ARB, ETH to wrap Bitcoin, and so on and so forth that you can get absurd returns on right now, which is what I would be considering if I was first getting into this platform. A 749% return is pretty good, especially for the smart contract risk that you would be taking on. Now, what I will say is they are a newer platform. They currently have a market size of roughly $160,000 on the Arbitrum network and roughly $100,000 over on Ethereum main network. Now, as you guys probably know, the majority of my portfolio is concentrated liquidity pools, and that's something that we go over often on the channel, so I went ahead and made a Uniswap V3 mini course. And truth is, this doesn't just work for Uniswap. This works for Trader Joe. This works for Orca. This works for all concentrated liquidity platforms because the math is the same. The principle is the same. The only difference is you're using a different platform, basically. Right now, it's on sale for only $35, and you have a plethora of benefits. Obviously, the main one is learning about Uniswap V3 and concentrated liquidity, finding out how to determine the best performing pools, as well as selecting the ranges and rebalancing those pools. We also zone in on impermanent loss and how that works in your portfolio and what you need to be aware of. But if you're on the fence about getting into the Uniswap V3 mini course, I'd say now is the time, considering we are going to be hosting a 1-hour Uniswap V3 market making seminar at the very end of this month on January 31st. This is probably going to be a one-time event that we will not host again, but obviously we're going to go over a ton of value about Uniswap V3 and concentrated liquidity. We're going to do position overviews of your positions, as well as we're going to answer any questions you guys may have related to Uniswap V3. And I'm going to be fully transparent with you guys. We have an opportunity where we will help you build out a robust DeFi passive income portfolio to make sure you're generating thousands of dollars per month. We've implemented this roadmap right here with 58 total clients, and I've seen amazing results over the past year that we've been doing this. So if you like what you see in the mini course, just head over to the info page, hit book a call, and there will be an application that you'll have to fill out because we are application only. But you'll be able to talk with myself personally before proceeding any further, so we can make sure that you're a good fit and a person that we want to have in our program, but most importantly, that our program is a good fit for you and can help move the needle to your goals. But getting back into things, I also have another Orca position. This is sold to Pyth. Now, I hopped into this one roughly a week and a half ago or so, deployed roughly $8,400, and that's currently worth $8,100. So I lost about $320 from price depreciation. Now, the thing is, I do have $150 in earnings, but honestly, this isn't up to my expectations. I hopped in this pool expecting to get roughly 120 to 150%, but instead it's doing an 80% APR. So it's doing nearly half of that, as well as I have $100 of impermanent loss. So ultimately, this pool is still a win for me, considering I am holding Pyth and I am holding Sol in my portfolio, but at the same time, it is in the red, and its APR is honestly too low for the risk that I'm taking on. So I'm probably going to be rebalancing this pool on Wednesday or Thursday of the week, just collecting a few more fees and just waiting for some price action for Solana as well as Pyth, hoping for it to go my way. And I did skip over a few different positions in here, these three right here, specifically because these are stablecoin position. And I'll go over these in just a second, but you'll also notice that my entire portfolio is doing roughly 44% APR, not 68%. So let's talk about what's actually doing 68%. When we take out these stablecoin positions and when we take out this Archimedes finance position, I am now doing 68% APR. And the reason why I say I'm doing 68% APR is because I actually am. On the assets that have market exposure that are not just single-sided, like Wrap Bitcoin to Matic, ETH to USDC, as well as Sol to Pyth, these are doing 68% APR. When you factor in the Ethereum to Ethereum Plus position, which is basically staking Ethereum, which is basically holding Ethereum as well, it brings it down to 62%. So I don't really like to consider this a DeFi passive income position. I am probably going to move it down here into my hold section, mainly because it's not really passive income. It's basically just earning on your Ethereum. And then when we factor in the three different stablecoin positions, it's doing 44%. Now, the reason why I'm not counting the stablecoin positions is, once again, they're single-sided, they're stablecoins, and they're market neutral. But most importantly is because these stablecoins are not mine. So whose are they? Well, they are borrowed assets. So essentially, I am leveraging some of my holds in my hold portfolio to borrow stablecoins and then, of course, yield farm with those stablecoins. So essentially, I have $14,000 of Ethereum, $3,300 of Matic X, 4,300 of staked AVAX, 2,700 of staked Sol, and then of course I have some Geom, some Wrap Bitcoin, and some other assets. I am essentially putting up all these assets as collateral, borrowing stablecoins against those assets, and then investing those stablecoins. So my average interest that I'm paying on that borrow is roughly 5%. But when we look specifically at my stablecoin positions, you can see that I'm doing roughly 21%. So I have a net 15% right there. And once again, not really worrying about liquidations considering I'm only borrowing 50% loan to value ratio. That means if I have $20,000, I'm only borrowing 10K. That way it would take a lot for me to actually get liquidated. The thing is, I'm going to be rebalancing my entire stablecoin portfolio to get it from 20% to roughly 30% per year. And a lot of these positions I will also be exiting, and I will be getting into some stuff that is a little bit more risky than what I'm currently doing, mainly because I do have a long-term approach to the market and I am long-term bullish on the market, at least for the rest of this year. That's going to wrap up today's video. Once again, now is the time to pull the trigger on the Uniswap V3 mini course. Over 350 people have already done that because we're going to be having the Uniswap V3 seminar on January 31st. I look forward to seeing you guys there and answering some of the questions you may have. Don't forget to drop a like, subscribe with notifications turned on so you don't miss out on my portfolio update coming early February. Peace out.